should be a good hour of your time. Just wanted to briefly overview the topics that we're going to be discussing. First of all, we have Tom Kelso with Matrix Capital Markets Group joining us today to speak about M&A activity that's ongoing in the industry. As we know, there's a lot of consolidation that's taking place. Private equity firms, public companies, MLPs have been aggressively expanding in the market, and Tom will give us an update on kind of where things stand both in the M&A activity and also in capital markets, so it should be a good use of time. Secondly, we'll have Jim Fisher to talk a little bit about how the industry is evolving in terms of using quantitative analysis to identify new sites out there. Real estate's becoming harder and harder to find, and finding those locations that are going to compete with the new store concepts in the next decade or so going forward is important. And then lastly, we'll have Mike Lashy with Paragon Solutions and talk about some of the trends that are taking place in the design of the store to help us compete going forward, as the old traditional kind of brand and store model is, I guess, becoming a little bit more depreciated, for lack of a better word, and it's important to have larger stores that can have the kind of offerings that consumers need, especially like food service and so forth. So Mike will be describing that more as we go. Just a couple things here. I've got everybody on mute just to keep a lot of background noise from occurring. If you do have a question, we invite you to ask any of those questions, but do so through your little type-in box dialogue system on the control panel. And then what I will do at the end is have a brief Q&A session where I can pass on your question to our panelists and they can answer it in turn. Also, as you can probably see on my screen, the contact information for each of the presenters. They would be very open to any follow-up questions that you have for them, and you can go ahead and contact them at those various email addresses. At this point, I'm going to go ahead and get started, and I'm going to turn controls over to Tom Kelso and allow Tom to take it from here.
Thanks, Jed. I hope everybody can hear me. And thanks, Jed. I hope everybody can hear me. Okay, we're good to go now. I wanted to open up by saying good afternoon to everybody, and to thank all of you for the opportunity to provide an update on the current factors driving the M&A markets. And I need to start by making a disclosure, a couple of disclosures. We're going to be, or I'm going to be talking about some public companies as part of my presentation, and I wanted to be clear that the public company information that we disclose here is definitely non-public, or there is no non-public or no confidential information to be discussed. Everything is publicly available information about those companies. And Matrix is a FINRA licensed broker-dealer. As such, all of our registered representatives must abide by FINRA regulations. We keep a restricted stock list at our firm as required, and all of the public companies that are discussed in this publication, with the exception of the Alarian MLP Index and the SPDR Standard & Poor's 500 Index, are on our restricted stock list, which means that none of our professionals or any person associated with our professionals can trade in any of these stocks, nor can our firm trade in any of these stocks. So, all the information that we present here today, or I present here today, is really for informational purposes only, and it's not done to try to induce you to buy or sell a security. And then there is also some discussion here of what may happen in the future, and any projections of what may happen in the future are simply projections, and there's no assurance that they will come true. Because there are some time limitations, I had not planned on covering every slide in this presentation. However, this presentation will be available through the Below the Line Club website and through JED, and so if you'd like to get a copy of it, you're more than welcome to have it. Jed, we're having a little technical difficulty here.
Okay.
The current M&A market is really something that I know everybody pays a lot of attention to. There's probably no week that goes by that some new deals are not being announced. This past week, we saw Susser being acquired by Energy Transfer Partners / Sunoco. And we also saw PMI in Virginia acquired by Lehigh Gas Partners. Consolidation is taking place for both C-store-centric companies and motor fuels distributors, and the valuations have reached the 2006-2000 levels or above, and in some cases well above where we were in 2006 and 2007, and certainly are as high as they have ever been since the really consolidation period started happening in 1999. And there is more buyer demand today than there are sellers. That doesn't mean that there are more buyers than there are sellers, but that means is that there are more, there's more buyer demand. There's almost an insatiable demand for companies by the buyers that are out there today, although geography does make some difference. And so what are the factors that are driving sellers into the market? From number one is that the motor fuels industry is mature, and so companies are having a difficult time maintaining gross profits from motor fuels because volumes are declining overall faster than gross profits are increasing. Companies are also experiencing challenges in maintaining C-store gross profits, and there are also higher operating costs, and the need for capital spending is ever increasing. And what we see in most of the companies that we look at is that costs are growing faster than gross profits, and every company is trying to find ways to spread their overheads, their costs over a wider base. We've always got increasing government regulation that's playing a larger and larger impact in driving sellers from the market, and there's an ever-increasing need for investment in technology and underground storage tank upgrades and other CapEx. And then you've got an aging population, for whatever reason there is, that an awful lot of the owners or shareholders are reaching retirement age in the industry. I'm going to let people review this chart. If you like to pull up this presentation, it's something I think is very interesting to look at. But then I want to talk a little bit about, what's the buyer perspective in driving M&A activity. And, there are companies that have made a clear decision that they're going to be long-term players in a mature industry. And those, are definitely the public C-store companies. It also includes some large privately held companies that are primarily C-store chains, but there are large privately held fuels distributors as well, and that also includes 7-Eleven. And then we get to MLPs, and as you'll see a little later on in this presentation, is that MLPs are very aggressive and are having a huge impact on valuations. We also have historically low interest rates, so companies that have made the commitment to staying in the industry, are using low-cost capital to do acquisitions, as well as make investments in technology and things in order to get the efficiencies from the acquisitions that they do. And then, in addition to debt, is that there's lots of capital out there available today for companies that are committed to growing in the industry. And that includes mezzanine and equity. and mezzanine and equity funds, basically are funds that are designed, solely to provide those types of capital. We've got companies that are accessing the public equity markets in the form of MLPs, and there is lots of senior debt money available from banks today. Just about all of the national banks and nearly all of the regional banks have petroleum and convenience store expertise within the banks. Other factors that are going to drive M&A activity in the future: high valuations induce more owners to sell, and the higher the valuations are getting, the more sellers there are entering into the market. I suspect at some point in time there will become an equilibrium where there actually is less demand than are actually sellers, but at this point there are still more buyer demand than there are sellers. But there are some other factors here that are also at play, in the future. At some point in time, at least some, maybe all, of the ACA will become implemented. Today, we don't see buyers factoring ACA costs in when they're doing valuations and bidding on deals, which, is having an impact in terms of, potentially keeping valuations high. There are unforeseen regulatory issues that I think will affect valuation at some point. Changes in interest rates will definitely affect valuation as the 10-year treasuries rise, and as well as LIBOR, prime, and other bank lending rates will rise with the Fed when any change in the Fed funds rates. Growth in the number of MLPs will affect, potential future M&A activity. We do expect that we'll see at least one, maybe two or three additional MLPs enter into the marketplace in the next year or so, assuming that the capital markets are still receptive. One of the things that we really need to watch are the future performance of MLPs with fuel distribution components. Traditionally MLPs have been strong in businesses like pipelines and terminals, where revenues and gross profits are ratable. As we all know, motor fuel margins contract and expand, and we have not seen any of the fuels distribution MLPs perform during a period of long motor fuel margin contraction. It'll be interesting to see what happens to them when that does happen. And then, this RIN issue, Renewable Fuel Standard issue, is always on the horizon, and at some point in time, could drive merchant refiners into the market trying to buy retail assets.
Tom, quick question for you. Do you have an outlook for these MLPs? I know as some of them started, there was kind of discussion in the industry that MLPs are the new way of things, and everything's ultimately going to consolidate into an MLP. And then other people have seen it more as a fad that's, temporary due to the historically low interest rate, the stock market being relatively overvalued in terms of price earnings multiples. Do you have any projections on what the future may look like for MLPs?
Well, we certainly, think that there is maybe some historical information that, might be instructive. To be honest, Jed, I think it's a little too early to say we're all going to end up being, everybody's going to end up selling to an MLP. I'm not sure that this business is still so fragmented that I'm not sure that we're ever going to get quite to that point. But I think there's some things that are really instructive here right now. And I assume on your screen you can see my cursor is I'm talking about the wholesale-focused MLPs, of which there are really only two, and that is Lehigh and Susser. And Susser, at some point in time in the fall, will likely no longer be a standalone and will be owned, at least the general partner will be owned by Energy Transfer Partners. You can see is that we have done these valuations as of May the 5th And what we're looking at here is that we want to see what the enterprise value multiple, enterprise EBITDA multiple is here. And the enterprise value that we calculate for each of these firms is the market cap plus the outstanding debt plus any cash or cash equivalents on the balance sheet. And you can see is that Lehigh is trading at about 14.7 times EBITDA, and Susser, with the transaction that was announced just prior to May 5th, is trading at 22.1 times. And you can also see is that if you look in the column here where the 10-year yield spread is, this is the spread over the 10-year Treasury that these companies are paying in order to induce investors into these companies. And you can see is that Lehigh is paying 4.92 times over, 4.92 over the 10-year Treasury of 2.63 for a total of 7.55. Is that dividend sustainable over time, especially if you get some contraction in motor fuels gross profits? We don't know the answer to that, and I think it's going to have a huge impact. Today Susser is trading at only a 2.06 over the 10-year Treasury, but I think that's an anomaly because of the way the transaction was just announced. So, you can see is that these are still relatively small companies. $51 million of EBITDA for Lehigh, $53 million of EBITDA for Susser. There are privately held businesses in this industry that are much larger than these are. So, how will these companies be affected as the markets change, as we go through, as the publicly traded markets change, as 10-year Treasuries rise, and as their performance is challenged in periods of tight motor fuels margins. If I look over on the next page, is that you can see how large, for example, Energy Transfer Partners is, with an enterprise value of about 39 versus Marathon, which is like 29. These are $29 billion. These are very, very large MLPs. And if you go back and you look at Lehigh, for an example, they've got an enterprise value of $746 million. So on a comparison basis is that, this is a very, very, very small, these are very small public companies right here. So, how much will they be affected if the stock market sells off, if interest rates rise, and I think until we can actually see that, I think it's really hard to predict how many more of them there will be. We do know that there is at least one, maybe two, that are really working hard to try to get out into the market while the public IPO market is somewhat receptive to it. But if people can't get public at a, it's going to be a real challenge to have a lot more MLPs, which means that, they can only buy so much. Even though they have enormous demand, at some point in time they have to be able to go back to the public equity markets and raise money. And, that's going to depend on this performance here. And, if they can continue to perform like this, then yes, they will continue to be very aggressive. If they don't, we're going to see, companies with, a very brief arc. So, I do have some slides here, I think, that are a little bit interesting here that, talk about how the MLP, the Alerian MLP index, has performed since 2004 versus the S&P 500, the SPDR ETF that tracks the S&P 500. And if you'd invested $1,000 in the S&P 500 index in 2004, you would have doubled your money through January 14. You would have gotten about a 400% return if you had invested in the Alerian MLP index. So, that is a very bullish sign. But here's a little bearish sign, which is the red line is the 10-year Treasury yield. The blue line is the performance of the Alerian MLP index since January of 1996. And you can see is that MLP valuations, returns on MLPs go up, or the index price level of MLPs goes up as the 10-year Treasury yield declines. And so as the 10-year Treasuries rise, I suspect is that this performance of the MLPs overall, not necessarily the ones specifically we're talking about, but just MLPs overall become less attractive investments, and it's harder for them to access capital and harder for them then to do acquisitions. So, that's why I'm not saying I'm bullish or bearish. I think it's going to bear watching. How long will it be before the 10-year Treasuries, really significantly rise and these MLP valuations fall? That I think is just a real question, and how many acquisitions can they get done between now and then? So I think I've just about used up my 20 minutes, Jed. So, this is available up on your website, and I'm happy. I'll stick around for any questions later.
All right. Well, one other question for you before we sign off, Tom. High multiples in the industry, forecasted decline in demand. I've heard some concern expressed among some. It's good for a seller going out, but for somebody looking to buy with projections that what they're buying may have fewer gallons going forward, is it worth paying the high multiple for it? Do you have any thoughts on that?
Well, we certainly, it's very difficult for a privately held business, I think, even with extremely low interest rates and about a 70-30 debt equity configuration, to do acquisitions at the prices that are being done today, and because there's just no way that if you run a projection model out and calculate your IRR that you're going to get the returns that you're looking for, and to be honest with you, I have to say is that we scratch our heads when we see the bids on coming across our desk for some companies, is that we really can't figure out at times as to how that makes sense unless people are getting the types of synergies in both cutting costs at the overhead level as well as buying synergies and being able to, buy better, throughout the entire chain, not only what they're buying, but what they already have, and that they're taking enough cost out of the system in order to be able to get, those returns. And when Sunoco announced the Susser transaction the other day, they talked about $70 million a year in forecasted synergies, and if they get the $70 million, then this is an accretive transaction for ETP. But that's a big if. But you can see that even at the public company level is that it's really all based on forecasted synergies, buying motor fuels better, convenience products better, and being able to spread overheads over a much wider base.
All right. Well, thank you, Tom. And as I mentioned to the audience, Tom's available for any other follow-up questions that one may have, or you can ask him here. I'm going to go ahead and turn controls now over to Jim Fisher. And Jim, we look forward to hearing from you a little bit about the trends that are taking place in site selection, which as people are looking to grow their business, bringing on new sites is a more integral part of it every day. So Jim, the floor is yours.
Hi, Jed. Thank you. Welcome, everybody. As Tom said, welcome and thanks for joining the webinar today. We're going, as Tom was saying, there's quite a bit of information on our slides as well as being used in a previous presentation. So some of the slides they will all be available through the study group that you can use, and we're always available for questions as well. So let's get started. Just briefly, one quick 15-second commercial on IMST. We're headquartered in Houston, Texas. We've been doing this for about 25 years as this company. The people within this company represent well over 250 years of experience within this industry. We're the largest firm serving the independent retailer in terms of site analysis. And coast to coast, border to border, we do approximately somewhere around 250 plus sites a year across specialty retail. Obviously, convenience store and fuel is very big for us, but we sort of do the gamut from hotels and shopping centers to fuel and stores. These are the topics that we'd really like to look at today, very briefly, but topics or categories that get involved with everything that we do in terms of new site development, existing facility improvement, be it major remodel, raise and rebuild, acquisitions in terms of for both the buyers and the sellers, and the as I said, the upgrading of the network of stores, which is the fastest, quickest result of the bottom line. Many of those efforts of the existing stores Mike will cover in his section at the end. What we want to look at today is the performance classifications, the performance metrics, the performance drivers, the performance detractors. In other words, the main things in a very clustered approach to looking at retail on an individual basis and not on an aggregate basis when it comes to a network, both in terms of current facilities owned by you, as well as those that might be looked at in terms of acquisition. We like to look at all existing facilities, all operating stores, as falling into one of four categories: non-performer, performer, dog, and superstar. In other words, if in the case of acquisition, where will our capital be spent? In the case of our own stores, where are we going to get the biggest return of capital expenditures on our facilities? Certainly, the first one we look at are the dogs. And in other words, they are the first ones to be taken out of the system. And when we say taken out of the system, it doesn't mean passed on to another generation of smaller operator. If they don't work for your company or other companies, then out of the industry, go for alternative use, go for best use, but don't go for necessarily just another dealer installation. So the dogs are the elimination. The superstars are the scary ones, because by all measures that are available, they exceed all levels of potential that would normally be thought of for that particular location. In other words, many cases it's an operational issue and it's a superior operating store. But when it comes to acquisitions or potential acquisitions, they are the ones that are the scariest in terms of expensive and price, because you don't know how long they will remain a superstar. The performer are those that are meeting or basically at the potential that exists within any specific trade area for that site. In other words, all cylinders are pumping and it's moving in the direction it should move. However, it has to be established is there really any significant potential left to achieve that would generate or justify capital expenditures. The last one is the biggest, and that's the non-performer. The facilities that are definitely performing below where the potential is. And that's where you establish, all right, if we take selected actions, case 1, case 2, case 3, how much of a real increase are we going to experience from that, and how much of a return will we get on it? Part of all this is viewed in the performance metrics. And basically, performance metrics, the way we look at it, is why is an existing store performing at the level that it is? And you have to have measurable categories to go against, like in many of the categories that are in the financials that you all deal with every month in terms of submission to the study groups. But on the gallons per fueling position in the dispenser configuration, it's very different to say in gallons per fueling position that we have four fueling positions, or we have 8 fueling positions and 4 dispensers, and a facility is doing 200,000 gallons under those 8 positions, and another facility is doing 110,000 gallons out of those same 4 dispensers or 8 positions. Likewise, if we're doing 100,000 gallons out of a parallel and with parallel configuration with 4 dispensers, as opposed to 100,000 gallons out of a dive-in configuration with the same 4 dispensers, which is an anomaly in most cases. Why are we experiencing both the capacity differentiation as well as the configuration differentiation? Likewise, as you come inside the store, and you can also do this in the case of food service operations, or food service offerings, I should say, is what is the dollars per square foot? If we're generating a location that's doing $90,000 a month out of 1,600 square feet, that's very different than generating $90,000 out of 3,100 square feet. Why? Or 100,000 out of 31, but 90 out of 16. What do we look for, and what can be expected that will be resolved or not resolved, or what could be expected? And lastly, and that is the store design, amenities, and parking. What is the facility? Let's establish what degree of operational expertise it has, and the experience level that's created for companies. Likewise, the other performance metrics that are looked at is the demand share. In other words, demand counts. Where does it come from in terms of population, households, employers? What we like to say is full day part or limited day part population or potential customer menu. And then traffic capture. What are our data sources? What is our actual traffic? How much is there? How accurate is it? How current is it? Where does it relate in relationship to our store itself? And then the number of pump and store transactions. What's our average fill? What's our average ticket inside the store? And then also, what is the difference between, or what's the comparison of percentages of sales of both fuel as well as convenience, and what percentage does each have of the other? As you probably have all heard, the old standard saying is, only 38% of fuel customers actually come inside the store. It has nothing to do with that intended trip of the in-store only customer. But where do we stand in terms of percentages, which is critical information to know, especially in terms of when you're looking at stores to possibly acquire. Then you have performance drivers. In other words, what's the trade area and how are we relating to that trade area? These are just some of the many things. It's, the additional is number of individuals per household, the number of cars per household, the ethnicity. But these are some critical issues to look at within the trade area. Once that trade area is established, as you see the little example trade area here, which is the typical rings, there's many cases where we're looking at radii, we're looking at drive times, we're looking at totally custom trade areas that are bounded and created on their own strict because of maybe rivers or bridges or military bases or whatever that changes that trade area, or extreme population density. So the demographics as well as the traffic quality. Both what we consider break down traffic into explained, spontaneous, and transient. Explained is basically that percentage of traffic that's exposed to that site on a daily basis, or that facility on a daily basis, that is generated or self-contained within the trade area itself, be it above the population, the household count, the employment base, institutions that might exist. Secondly is the spontaneous traffic, and the way we look at that is that's traffic. It might be daily traffic that's exposed to the site or the store, but it's daily traffic that's coming from outside the transit, the trade area, but on a routine basis. And then lastly, transient. Most important to interstate locations or limited access highways, least important to urban or suburban areas. It's the ones you can't depend upon. It's the fleeting exposure to a site on maybe one occasion or very infrequent occasion. And then performance drivers, these are some of the things we look at. What we call shopping mission is the explained demand, frequency, activity generators, urban shoppers, the suburban shoppers, and the rural shoppers, all very different. The urban shopper and the rural shopper are totally different in their characteristics and makeup of what they're looking for. Each one of the shoppers represent a very diverse wants and needs, and the store the facility on how they're going to satisfy those diverse wants and needs of those categories. Activity generators, we all think about it as other retail or institutions, hospitals, schools, prisons are phenomenal activity generators as far as that goes. But who are the activity generators, and what are the destination points that will greatly impact us and that we can take, that are allies to us, that we can take advantage of and relate to. And then the frequency of customer base, the frequency of shopping is an area where we're going to see have multiple trips out of the same customers on a daily basis, or we're going to have very limited trips or non-regular trips out of the customer base. Are we going to get them from the fueling islands, from the fuel forecourt into the store? Those are all determinations. In other words, in a very quick way to say it is what it says there: would you visit this store to buy a candy bar and a fountain drink? Would it be convenient? Would it be accessible? Would it become part of our life? Because what we're really doing in this industry is we're trying to establish locations that become part of our customers' lives. We become part of their habitual behavior and part of their daily life and pattern of living. And then the primary performance detractors, as we all know, is competition, be it pricing, proximity, capacity, attractiveness, and certainly operations. The level of operation, how good is it, and who are our competitors? It's like we're just reviewing a project here this morning for a new site that has 13 competitors within about 3 minutes of drive time and around 2 miles of radius. However, even though it's a large number of competitors with that 13, they're extremely poor in the level of operational quality in the overall facility, and they're definitely the vast majority are outdated, with none being, the newest facility being 20+ years old, serving that trade area. So there's a great opportunity for a new generation, well-operated, strong branded store to enter and become a dominant factor within that market. And then the performance detractors, as well as the convenience restrictions, in other words, of our site. What's our access, what's our road configuration, how visible are we? Is intersection movement and stacking a problem? We see on a daily basis almost where when it comes to intersection traffic and movement, and go back to traffic counts and traffic level, traffic volume is a bell curve. As it grows and grows and grows, it's positive, positive, positive on the site. Then once it reaches its peak of that curve, after that point it becomes a negative. And traffic or sites, potential sites, and as well as existing stores, because of change in road configuration or change in access, traffic and movement can become it can be just as a strong negative as it is a positive. You look at this one, this is a prime example. This looks like a good corner site. However, on further review, when you look at it there, it's a right in, right out only location existing with the right-hand turn lane only. So it's extremely limited in terms of you know, when we start dealing with it, somebody can say, well, there's 30 or 35,000 cars going through this intersection on a daily basis, but how many are really accessible to us, and how many really mean any sort of viability or importance to our site? So there's all issues to be looking at, as well as the trade area barriers themselves, the road networks, changes in the neighborhood. We basically can look back at facilities and know that a facility that's 5 years old, 10 years old, 15 years old, those neighborhoods have changed, and they've changed significantly, which means that our facilities have to change, and they have to be in line with the changes in those neighborhoods, as well as the natural barriers and what we were just talking about just on the last slide, the traffic intensity. How has the traffic increased, as well as the road networks? Maybe as the national debate's going on right now with, are we going to change a lot of the interstates to toll roads? That's going to have a major impact on a lot of facilities, both that are associated. I mean, that's going to be a critical nature that will impact not only truck stops, we're looking at it, and NATSO's looking at it strongly, but it will affect all those retail, food service, hospitality destinations that are on there. Or when a new toll road opens, or when a new expressway opens, or when a new interchange opens that will directly impact the other interchanges that are serving basically the same trade area. So, very quickly, and apologize for the time limitations, but that's what we have, is really looking at, in terms of this, you know, the structured process to identify potential and quantify performance of our stores, as well as possible stores that we're looking to buy. You know, by us profiling our stores, and by us looking at individual stores and not just the aggregate and not just industry averages, which industry averages can be extremely misleading, especially when the inclusion of trade areas, types of trade areas, be it urban, suburban, rural, as we were talking earlier, can be extremely misleading when you start benchmarking a lot of the benchmarks against industry averages with a small sample base, or a smaller sample base. So it's using our meaning our company's way that we've evaluated all of our existing retail facilities to say, here's our profile of our stores. How do they compare? Once again, say, where do we spend our capital? Where are we going to get the biggest return? Here, one of sort of the most important sites are owned and operating stores, which is true. The quickest result to the bottom line of any retail organization is to say, how can we improve our existing stores to get a really strong positive return on the dollar spent? And then performance due diligence process, the classification, once again, as we were saying, of the 4 types, be it performers, non-performers, superstars, and dogs, basically saying in what you don't want any acquisition or accumulation is to have any superstars or any dogs. And then the metrics of rationalization, classification, and potential are drivers that we were using, how to explain demand, and then also the detractors on how we're going to be negatively impacted by the environment that we're in. And it's all about sales performance, and which we say is, you know, is best explained by fit, demand, execution, and response, and how we properly serve the trade area. The overall philosophy we don't believe in is build it and they will come, because if you just build it, they will not come, you can guarantee you. But if you build what the trade area needs and what the trade area shows it's lacking in, they will certainly respond and they'll certainly come. So thanks, and Jed, it's back to you, so you can turn it to Michael, and I will be around at the end too.
Quick question for you, Jim.
Yes.
In your experience, what's the most common overlooked factors that impact performance?
Oh, Jed, toughie. One of the most common overlooked factors is to say the trade area generates the potential of this, and I'll answer that in terms of let's say a new to the industry, a new build. The potential of a site is X. It's X number of gallons, let's say. It's X number of inside sales dollars, and it's X number of let's say food service dollars if we're going to have a proprietary food service. Here's the potential that can be done, but physically, can we achieve it? In other words, maybe it's going to take us to achieve the potential. It requires that it's a 4,000 square foot store, and it's 8 dispensers with 16 fueling positions, and we need to have a proprietary grab-and-go on-site food service program with the drive-through window. However, we have a site that's 30,000 square feet. Well, you can't accomplish it. You can't accomplish it without cannibalizing the different one or all profit centers. So therefore, one of the biggest things that gets overlooked significantly, which Mike can certainly address too, is the site truly viable for what the site is potentially capable of achieving, while giving each profit center, each distinct profit center, be it fuel, be it store, be it food service, be it, I don't know, dry cleaner, liquor store, whatever, has certain needs that must be addressed to properly integrate those diverse profit centers on any single site. They must be addressed. And if they're not properly addressed, I guarantee you something's going to be cannibalized. There's one or more of the profit centers that will be cannibalized at the expense of others. And that most routinely is always exemplified in examples. You can go at nearly every city and say co-branded units between a national co-branded food service operation and a convenience store that were not properly executed in terms of space and needs, and it's the first thing that gets cannibalized is the store, the second thing that gets cannibalized is the fuel, the one thing that never gets cannibalized is the McDonald's.
Yeah. Well, good thoughts, Jim. I appreciate your time here, and I'll
turn
it over to Mike. And so, Mike, you've got the controls now. We've heard a little bit about site selection, and one of the things people have to try to figure out is after they got a site, what do they put on it? How do they brand it, position it, et cetera?
Yeah, thanks, Fred. I appreciate the opportunity to talk today. What I wanted to do today is maybe a little different than you might expect. You probably know me as a designer of prototype stores, remodel stores. Today,
now, Mike, I don't know if others are getting feedback as well. Jim, are you getting feedback?
Yes.
Yeah. Are you on a speakerphone, Mike?
No, I'm not. Is that better?
Go ahead.
All right, I'll do the best I can not to talk twice.
Sounds good.
I'm going to talk about branding, and specifically, since Tom talked about M&A and Jim's talking about new site development or acquiring sites, I wanted to talk about the assimilation once you acquire that site or once you build that site. And so I'm going to start with a couple quotes that I actually used in the below the line newsletter this week or this month. The best way to predict your future is to create it, and that's where I'm talking about taking hold of your brand and creating your own visual, creating your own brand, not letting it come to you. Too many times we let either the major oil companies or other people tell us what to do and tell us how to look, when really it should be about your brand, not about theirs. It should be about your growth, not theirs. And that's what that means for me. And the only thing we do know about the future, I think Tom picked it very well, it's going to be different. We might not know exactly what it is, but it's going to be different. So being flexible as we create our brand going forward is the key. Now I'm going to use a couple different case studies here, examples of stores that we've done in the last couple of years, and just share the story, because I think what that will do is illustrate better than anything else what I'm talking about. Berkshire Brothers is a grocery chain out of East Texas, and they wanted to get into the mid-market markets, and they already had small convenience stores. They're known for their larger supermarkets, of course. But when they got into mid-markets, they knew that just putting a Brookshire Brothers on it was not what they needed, because that brand represents grocery stores. So we created a new look, a new vision in developing the brand for Cormie's Grocery. So they still wanted to say, okay, we're old school, we're, East Texas, Cormie's Grocery, from the architecture that was developed to the materials that were brought inside. You get a sense of, okay, well, this is quality, this is country, this is East Texas. And that's really the image that they wanted to present. From their fresh meats and their butcher department to all the latest technologies, this really does represent, that mid-market grocery that they wanted to accomplish. So I think this was a very successful one. It's meeting and exceeding all their projections. Another example, and going back to the Cormies, I guess, for just a second, it's important if you're going from convenience up to mid-market or from grocery down to mid-market that you reevaluate your brand, reevaluate your image and the message. So that's the message there. High Road is out of Clarksville, Tennessee. And when On the Run was bought by Couche-Tard, and all of a sudden they had an opportunity, I guess you might say, to decide who they wanted to be. They were no longer getting the support that they wanted from Couche-Tard, and so they said, well, we're going to create our own vision. We're going to create our own brand. Now, they came up with the name High Road. I think it's a great one, and they were incredibly creative and receptive to creative ideas. When you see the way that the High Road brand here is reflected, you see the HI and the yellow being the two dominant things, and that was totally intentional. The reinforcement of that brand has been done on new stores and remodels now, and it's been very successful. One of my favorites is, as we did their private label water, and you see it right here, doing the high waters, which those of us that have 85-year-old fathers can really appreciate that, the high waters. So they brought their personality in, they had a little bit of fun, and that's what you have to understand about your brand, is that it is an exact reflection of who you are, who your culture is as a company, as a corporation. And that can be reflected in so many ways. It's not just the graphics, it's all of the signage throughout, it's the music, it's the lighting, it's everything having to do with who you are in the store that reflects your brand. So this particular program has been very successful. They've done a number of remodels as well as a number of new stores, and it's been a very successful transfer from the On the Run to High Road. The third case study I wanted to share with you, and I appreciated Jim's last slide where he had the cows and he circled one. Well, if any of you have read Seth Godin's business book, The Purple Cow, you'll know that Jim's illustration there was spot on. How do you stand out in a crowd is the basis for Seth Godin's book. He talks about driving down the road and seeing a cow, and isn't that cute, and then seeing another one, isn't that cute. By the time you see a herd of cows, they all look alike, and who cares? But if you see one purple cow, you say, holy cow, look at that. And that's the basis of his entire book. Well, this one here, the Purple Cow convenience chain, I was riding with Brian and Keith Baker, and when Keith first came up with the name Purple Cow, Brian and I looked at him and said, you're crazy, that's the dumbest name we've ever heard of. And the more we thought about it, the more genius it was. Keith was spot on. It is all about standing out. So the way you do it in this particular case is two things. Again, bringing the name, Purple Cow, uniqueness, bringing the pop of color. The purple, obviously, is throughout the store in very strategic ways. And, then all the operational things that go with it. But as they got back into retail, they did not want to just be another Shell. They did not want to be just another Valero. They wanted to stand out in the crowd. And they have done that, and done that very well. So for them, as they got back into retail from being pretty much a wholesaler with a dealer network, they created a new name, a new vision, and that was the Purple Cow. Another example, I talked before about it's more than just the graphics. It really is every way that you communicate. And this chain is up in Pennsylvania, and it started with a vision. If you look in the lower right here, you'll see a covered bridge, and they had a picture of this covered bridge. And this has meaning to them. It's a historical bridge over Rough Creek. They said, that has meaning for a lot of people here locally. How can we reflect that in our brand? Well, Rough Creek Markets was born, and what you'll see throughout the various elements of Rough Creek is the covered bridge. The covered bridge is the icon that will be consistent throughout the entire thing. So whether it's their awesome chicken, their commissary sandwiches, their private label water, their custom brewed tea, their smoked jerky, whatever it is, the Rough Creek brand is going to be consistently executed from the top down. We're in the process of working on a number of remodels for them. They've got 2 of them up, and they are exceptional for remodels. We're working on a couple new stores as we talk. So this is a great example of a work in process, but how you can take that brand and build consistency. The thing that I see in so many examples around the country is you've got a plethora of brands within your store. You might have a sign out front that says, Joe's C-Store, but as you go through the store, you see someone else's coffee, and you see someone else's food service, and you see someone else's beer cave, or whatever it is, and your brand ends up taking a second tier. And I think that's one of the problems in our industry is we're not as conscious of our brand. I think it essentially becomes even more critical as you acquire other people's brands, as you acquire other people's locations. How are you going to assimilate them into your brand? Well, oftentimes it's just by, the old term, putting lipstick on a pig. We leave them alone because we don't know what to do. If it was a Food Mart Island Marketer, we leave it a Food Mart Island Marketer. If it was a generic store, we paint it a different color and say we're done. And a lot of times, for what I've seen, is that the brand is not strong enough to assimilate other locations. So just by doing nothing, that's all we know how to do. But by developing a strong brand, you're able to create the ability to assimilate and get those synergies and get that recognition out there that you really want. A great example of a site where in Arkansas is Jam Mart. They had I guess the JAM is the 3 children, and all they had was JAM. And we brought in a little bit of personality, things like We Be Jammin'. We brought in kind of a fun, frilly look. The colors are bright, awesome. They've got a Dunkin' Donuts attached to it, as well as the Dunkin' Donuts kiosk. Everything about it was new age, very progressive for Fayetteville, or Fort Worth, Arkansas, rather. And just a great example of taking a tired brand, which was fairly generic JAM, and bringing it to Jam Mart and making it their own and making it fun and not just an afterthought. You see so many names out there that don't give inspiration, don't really communicate the brand very well. Well, I think the name's important, but it's how it's executed is more important, and how it's carried through the entire store. So this particular store, again, was a very fun one, very successful one. Tom was talking about Susser earlier, and we've had the privilege of working with them on their dealer program. And here's a challenge for all of you. What do you do with those assets that you have turned into dealers? Because all of a sudden, the major oil companies are not giving the support. They're not giving the marketing support. So what do? A lot of those stores are dying on the vine as they continue to deteriorate. Well, Susser has said, well, we're going to offer you the Icebox brand complete with marketing, and they asked us to develop the prototype. So we did. We took a tired logo, gave it life. We took a tired bird and gave it life, gave it personality, and I think the net result speaks for itself. It's simple, it's straightforward, and they're going to have the marketing support to support those dealers. So one of your very important networks is your dealer network, whether it's just a wholesale contract or your property. So the question I ask you is, what support are you giving them? Are you just putting a branded fuel on the outside and saying good luck? Or are you offering them opportunities, to participate in a brand? I think that can be one of the differentiators for you as you pursue those opportunities, as you try to help those dealers develop. Not all of them will want to participate, but a lot of them will. And I think Susser's Icebox program is a great example of what you can do for them. I'm going to finish up with one final opportunity, and that's Hutch's in Oklahoma. David Hutchinson has been in this business for a while, a great operator, great family, and his brand was a little bit tired. He wanted to take a new approach. He's competing with a couple of the big boys that you might know from Oklahoma up there. So how do you compete at that level? Well, in this case, a progressive design on the building, something that's a little bit unique materials, something that actually could be retrofitted on existing stores fairly easily. And that's what we're looking at, is how do you take this brand and retrofit it into an existing facility? For the most part, those facilities are just boxes. And you can put the dressing around the box in a variety of different ways. But what I see a lot of people doing is underestimating that assimilation cost. When you bring additional sites in, or whether you build new sites, are you actually putting a budget in there to bring those facilities up to par, up to your par, not the par of the people that you're buying? There's a reason you're buying them. If you are acquiring assets, you're acquiring them for opportunities for growth. And to me, bringing your brand as part of that and assimilating your brand into it is the way to build that growth. So I challenge you to look at those sites as you acquire them, to look at those new prototypes as an opportunity to upgrade your brand, an opportunity to take you to the next level in order to compete in this market. Because it is going to change, we know that. And I think the ones that are the more progressive, the people that are more progressive in their brand development will be the winners in this particular war. So, Jed, with that, that's all I have. That's my 17 minutes of discussion, and I would be happy to hang on and answer any questions.
Sounds great. Thank you, Mike. And I thought it was interesting you touched on a point about not just company-operated stores, but dealers, and providing dealers with an image or a brand that they can use and leverage. I think a lot of times we view our dealers, I think what you said, we just give them a major oil company brand and let them run with that. Do you see a greater trend of distributors who have dealers using a brand for their dealers?
Absolutely. And in the last couple of years, I've noticed, just like Icebox for Susser. Susser's got Stripes as their primary brand for their company ops, but then they've got Icebox for their dealers. So there is a difference, and that's okay, but they wanted to give them the support. And I think that's critical, is to give your dealers the best opportunity to succeed is going to help you to succeed. I mean, we don't want turnover in dealers. We don't want that site to be unsuccessful. So sometimes if you lead the horse to water, they will drink it, and it will be a good thing. And all it takes is for one of those dealers, one of the leaders, to have success in working with you on that brand, and the rest of them will very quickly see what's going on and want to participate. So it's definitely a trend.
Mm-hmm. And something else that jumped out to me is you said, like a lot of people think about, well, if I build this new store, then I can attach my own private brand to it, or create a brand around it. But you kind of mentioned that you can do that as well with existing sites. You're a little bit more limited probably in your options, but it's a feasible thing that a lot of people do.
Absolutely. And what I find is you're not as limited as you might think initially. It takes a little creativity it takes a little thought. But if you have a strong brand, and if you've developed the components for your brand, and it's not just a sign on the front door, then all those little touches will be consistent throughout your store. And that's how you take that brand from, say, an existing store to one that you've just acquired pretty quickly. But it's when you have that almost non-brand that people don't pay attention to it and you don't get the return.
Mm-hmm. Well, thank you very much, Mike. I do have one question that came in. It's actually, Tom, for you. Are you still there, Tom?
I am.
All right. It's from one of the members. Says, what's the tipping point for refiners to re-enter the retail market?
I assume the question means the branded refiners, the major oil companies, and
that's how I'm
interpreting. If history is any guide, Jed, I would say that as long as the major oil companies continue to own refineries in the United States, is that we're probably going to see a period of time as the deed restrictions and the gallonage requirements that were part of the deals when the major oil companies sold off all those assets, when those things start to come near expiration and they realize that the only way that they're going to keep those gallons is to purchase them a second time by giving huge incentives to the people who own those properties, or they're going to have to come back in and start buying some of this stuff back because an awful lot of people see unbranded as the future, or they want to be a free agent and to be able to shop brand. And so in the case of BP packages, we're already running on that. You're running up on that 10 or 15, 20-year deed restrictions are coming up now, or starting to come up now through about 2022. With Exxon, the restrictions will last probably until about 2025, and with Shell probably somewhere between 2022 and 2025. And so as we get more into this decade, the landscape will become clearer. Is that the major oil companies will either exit refining in the United States, or they'll be confronted with either having to buy that volume for another 10 years, or they'll have to go out and actually buy the properties back, buy the businesses back, or start building new ones.
Mm-hmm.
We've seen it before, but I think now we definitely have some time frames because of the expiration of these contractual agreements and the deed restrictions.
All right. Well, appreciate that insight, Tom. Jim mentioned he wanted to make one last comment.
Unmuted.
So.
Well, the one last comment, Jed, was when you asked me that question, I said, well, that's a tough question, and I came up in mind, and all of a sudden I forgot. I realized one thing that it seems like we forget very often, which is the blood and bones of this industry is Bubba. And a great presentation was made at CRU several years ago by a research company on Bubba. And we concentrate in many cases on soccer moms and white collar and whatever, but a major thing we can never overlook in this facility, in this industry, is Bubba himself. And then in turn, what Mike was saying is that the one thing we can't overlook either is our dealer business that we have, and those distributors, those marketers that are really focusing on developing a wide-ranging educational program for their dealer network, are becoming extremely successful in helping the dealers manage and grow their business. Anyway, that's what I wanted to say.
All right, thank you, Jim. I think at this point we will wrap up the call. I appreciate everybody taking the time to be on it. Again, you have Tom, Jim, and Mike's contact information, and feel free to reach out to them. I will be sending out in a couple days the slides to everybody from these from this presentation. So appreciate you all being on the call. Wish you the best and hope you have a great day. Goodbye.